Hey everybody, my name is Dr. Brian Winrow. I'm a tax attorney and tax professor, and what I'm going to be talking about today is going to be our S corporations, which is the final of our entities that we need to talk about. We've already talked about our C corporation and our partnerships and LLC, so this is the final component of looking at our different business entities. So when we're talking about an S corporation, we're going to see there's a lot of similarities between C corporations and our flow-through entities. So it's kind of a hybrid between the two. For example, when we're talking about forming an S corporation, well, we look over to the C corporation because what often happens is you're forming your C corporation, and after you form the C corporation, you make an S election. Now, that's not always that. It doesn't always start out as a C corporation. Sometimes you're a partnership, and then you're going to decide you want to become an S corporation or whatever. But what usually happens is you're forming a C corporation, and then once you form the C corporation, you're going to go ahead and you're going to make the S election to be taxed as an S corporation. So all those rules that we talked about when we were dealing with the C corporation as it relates to section 351, well, that's going to apply to our S corporation. Now, if you remember section 351, that is not a mandatory non-recognition of gain or loss, where if you're putting in cash or property in exchange for stock, then you don't recognize any realized gain or loss on the contribution of that property or cash to the S corporation or to the business entity. So if you had, say, property that had, let's go and say, a basis of $100,000 but a fair market value of $150,000, if you sold it, you would say, oh, well, if my basis is $100,000 and fair market value is $150,000, I have $50,000 of gain. I have to recognize that realized gain. But that's what 351 prevents, right? So what we're doing is we're putting into the corporation, and if all we get back is our stock, then we're not going to recognize that $50,000 of gain. Instead, we will now take that $100,000, which was our basis in the property, and that's going to be our basis in the stock that we receive. And the S corporation is going to take our property, and it's going to have $100,000 of basis for the property, which was a basis that the contributing partner or the contributing shareholder had. Okay, so that's going to be, remember, in the 80% control, right? 80% control immediately following the transaction. Those rules are applying here when we're dealing with our S corporation. So we're looking at section 351. Other rules that are similar with the C corporation is we're going to go ahead and we have the same rules with non-liquidating and liquidating distributions, okay? So we're going to have those same rules that are applying in terms of that they're generally not going to be taxable. Now, when we look over here at the partnership side, well, there's a lot of similarities between the S Corp and a partnership. They're both flow-through entities. And as we talked about with a partnership, that means that the S Corporation does not pay federal income taxes as it earns the money. Instead, what it does is the profits and losses, all that stuff flows through to the individual shareholders, and the shareholders are then going to recognize gain or loss at their individual tax level. Okay, that's one of the big advantages to it. Now, there's some other things that we could talk about between your C corporation or any of your limited partnership type of entities. There's going to be limited liability protection, so you're generally shielded from being personally liable for many of the obligations of the entity of the S corporation, so you're going to have that attribute as well. One big distinguishing factor, however, between the S corp and the partnership is many people are always saying, well, why do accountants often say go with a S corp versus a partnership, a LLP or whatever? Well, one of the big things has to do with self-employment tax. Okay, so when you have an S corporation and you're not a passive investor, you're actively involved in it, what's going to happen is you need to withdraw a reasonable salary. Okay, and you're being taxed on that salary, and the corporation gets to deduct that all that requirements, right? Just what you'd expect with like a C corporation when you have an employee right there. But outside of your salary, the distributions that are coming to the shareholder from the corporation, the shareholder is not going to have to pay self-employment tax on those distributions, and that's a pretty big advantage, right? They're not paying self-employment taxes on it. Okay, so it's a huge benefit for the S corporation versus a partnership where you might be paying that profit, the income on that. So what will happen in this video is I'm going to go ahead and I'm going to start out talking about the requirements for the S corporation. Okay, so before I go straight into the requirements, I'm going to deviate a little bit because you're going to see the shareholder classification for a family. So I'm going to show you that a family, right, if they're within 6 generations, can be classified as one shareholder. Okay, so they're going to be one shareholder because we're going to see there's a limit on the number of shareholders that you can have, and it's going to be 100 theoretically. But because of these family rules, you could have numerous family members and they're only going to classify as one. So technically you could have far more than 100 shareholders, even though if you read the code and everything, it's saying, okay, 100 shareholder maximum. But because of the way it classifies family as one shareholder, we kind of get around that. But we'll look at those rules first, and then I'm going to jump over and I'll just start going through the requirements. I'm going to talk about requirements relating to the number of shareholders, to who can own the S corporation shares, right? So, for example, do you have to be a U.S. citizen? Can a corporation own it? We're going to go through those different rules that relate to it. We're going to talk about what percentage of the shareholders have to agree in order to form the S election, when it's going to be effective. We're going to look at that rule as well. So we'll go through those different rules. And then what we'll have to do is we're going to go through and we're going to look at how do you terminate an S election. Okay, we're going to see voluntary versus involuntary, but we're going to go through those rules. And then we're going to finally end by talking about what happens when there is a termination, and now you may have a short tax year. Part of the year you're an S corporation, and part of the year you're perhaps a C corporation. So we're going to talk about how you handle that as well. So quite a few things in this video that are important for you for the CPA exam, enrolled agent exam, or perhaps in your classes. They're going to be things that you're going to be tested on as well. I will also work through some example problems for you so you can kind of see these concepts in practice and in application. I'll have a second video that goes through and talks about basis and some of the other requirements, but for right now, all we're looking at is formation, termination, and short tax year. That's our primary focus. All right, well, let's go ahead and start talking about that family rule as to who qualifies as a single shareholder. Okay, so I previously alluded to the fact that you can only have 100 shareholders within an S corporation. So we have a ceiling, a flat ceiling of 100 shareholders. However, that 100 shareholders is kind of flexible in a way, because what we have is this family rule that treats certain family members as one family member for the purpose of the 100 shareholder limit. So, if you're within 6 generations and you're a descendant from, your ancestors in your 6 generations, then you're going to be able to be counted as one shareholder. So, for example, let's say that your grandparents own stocks in a corporation, and then your parents buy stocks in that corporation, and then you buy stocks in that corporation, and then your kids buy stocks in that corporation. All of a sudden there's 4 different individuals. We're not even counting spouses and everything else. So there's 4 individuals right there. Okay, you count as one shareholder. So imagine if there's 100 other shareholders and they're all doing the same thing. Well, you get way past 100, right? So let's look at these rules. Children, grandchildren, grandparents, spouse of any of them. So your grandma, your grandpa, right, would be 1. Your mom, your dad, they count as 1. Your spouse, that counts as 1. Your grandchildren's, your children or your grandchildren's spouses count as 1. So all of these are counting as 1. And it's not only the spouse, it's an ex-spouse as well. You can't get away from your ex, no matter how hard you try, right? For this rule, it still applies. So if you had a former spouse, or maybe 4 or 5 former spouses, hey, they all count as a single shareholder. One big happy family, right? With a current spouse, ex-spouse 1, ex-spouse 2, ex-spouse 3, and you can go down the line. It doesn't matter. You're one happy family. And it sounds weird. It kind of sounds weird. It might even sound cruel to some people, But here's the reason why. Because there is a limit of 100 shareholders, the code stops it so that way if there's a divorce, it's not going to then terminate the S election because now you have 101 shareholders. They're just considered one shareholder as well. So it kind of removes a barrier that could otherwise exist. So even though it sounds weird, it's shareholder friendly. Okay, so let's look at others. Siblings. So you and your sibling own a share. Hey, great. You're one shareholder. But not your in-laws. Okay, your in-laws don't count. Stepchildren do not count for whatever reason. Stepchildren do not. Adopted children do. Stepchildren do not count as a separate shareholder under this rule. So they if your stepchildren owned it, they would be a separate shareholder than you. Although there's some other things with that, but we'll leave it right there. And then just a few others that do not count. Anybody you're living with, your live-in partner, whoever you're dating, a fiance, they don't count. They don't count. Okay? You have to be married, right? Kind of like Beyonce said, you have to put a ring on it, right? Before they're going to count. No ring, they don't count. All right, so hey, let's go ahead. Let's go do this. We're going to go ahead and we're going to work through a couple quick examples on this. Make sure you have this rule down, and then we're going to get to the formation requirements, who can own the shares, and all that aspect before we get to termination of it. So let's go ahead and let's look at those examples now. So here's our first example. It's a pretty simple example. I just wanted to go ahead and give you a visual of what we're dealing with. So the first thing we see is a grandparents and spouse. Well, we know your grandparent and spouse, that they count as one, right? So even they're a married couple, even though both of them may own shares, hey, they're one for this rule. Then what we do is we say, okay, your grandparents had 2 children, child 1, child 2. All right. Well, the child 1 and child 2, child 1 is married and child 2 has an ex-spouse. Okay, guess what? Grandparent, spouse count as one. So do child 1 and spouse 1, child 2 and spouse 2, ex-spouse, right? They all count as a single shareholder. We only have one shareholder so far. Okay, we only have one shareholder. Then we look at from child 1 has a grandkid 1 and grandchild 2 who's been adopted. Okay. Hey, that's okay, right? We can have adopted. Stepchildren, no, but adopted, sure. So grandchild 1 and grandchild 2, they're still part of that whole same family. We still only have one shareholder, from grandparents to child to grandchildren to all their spouses. That's counting. So grandchild 2 who's been adopted and grandchild 2's spouse, that's one shareholder. Then we have grandchild 3 and grandchild 3 spouse. That's one shareholder. Okay. So far, all of those just count as a single shareholder. The only person on this entire visual that does not is the one that's bolded in red that says the boyfriend in this example. You gotta be married. So grandchild 1's boyfriend does not count as a part of the family. If the boyfriend owns shares as well, then we have 2 shareholders now out of this whole group. Otherwise, everybody else counts as a single shareholder. Hey, I did another little example on here. I mean, same thing, we can look at it, but let's remove the grandparents and let's just look at it. What would happen if it was just child 1 and child 2 that owned the shares? Okay, how many would they count as? Would they be 1 or would they be 2? Well, hopefully you're saying they're 1. Right? Because siblings, they count as a single shareholder. So even if grandparents don't own it, if child 1, child 2 both own shares, they're going to count as a single shareholder. Okay? And the same thing, if you look down where I put grandchild 2 who's adopted and then grandchild 3, if it's just those 2 that own the shares, hey, they're still a single shareholder because cousins count as well. So I wanted you to see examples with spouses, ex-spouses, cousins, adopted, and then a boyfriend tossed in there as well. But that's going to be your first example. everybody but the boyfriend counted as one shareholder. So we had one, and then if the boyfriend has has shares as well, now this whole image, there's only 2 total shareholders in that entire scenario. All right, let's look at some more. Let's look at a couple more quick questions before we move on to the formation, the requirements to be an S Corp, and some of those details. Here are the remaining 2 problems that we're going to look at, and like I said, very quick ones. So the first one, let's say we have a corporation and our owners are going to be Brandon's ex-spouse Mia, and their adult daughter Zoe. Let's say she's 34 years old. How many shareholders do we have? 1, right? It's going to be Brandon's ex Mia, doesn't matter if they're married or not anymore, and their adult child, doesn't matter if they're an adult or not, but their child, Zoe. So there's 3 people, but they all count as 1 within the family rule. Here's our other one. Douglas's sister Lily, so we know Douglas and Douglas's siblings, they count as 1, okay? Their cousin, Mateo, we know cousins count as 1, they're part of the family. And Mateo's ex-spouse, Ava, she counts as 1. So in both of these scenarios, we're just going to have 1 shareholder. Okay, so when we're trying to get to that 100 limit, right, we want to make sure we don't go over that 100 limit. They all count as just a single shareholder, even though you can see here, like on the second problem, Douglas, the sister Lily, Mateo's ex, there's 4 people. No, we're just going to count them as 1. So that's why I say you can get past 100 pretty easily because of these types of rules. All right. Well, those were the first initial practice problems. So what we need to go do now is we need to start looking at what are the requirements in order to form our S corporation. So who can own shares in the S corporation, right? Who's able to own shares? How do we make the election? I mean, who has to agree to the election? Those types of things. So let's go start talking about that right now. So here are our qualifications in order to form our S corporation. Like I've been talking about, we're limited to 100 shareholders, but we know from the family rule that it can easily get past 100. But if you see this on the exam, CPA exam or otherwise, oftentimes they'll ask you a single question like, hey, it's limited to how many shareholders or something like that. It's theoretically 100, but we can get past that, right? But 100 is a number you should be thinking of initially. So remember, all families, 6 generations. Well, I shouldn't say all family, but this family rule tells us if it's going to count as 1, and we're limited to within 6 generations. So that's the first type. Number of shareholders limited to 100. Second thing, S corporation can only offer 1 form of stock. Now this trips up students, so please pay attention here. You cannot have preferred and common stock. Okay, so you can't have a type of stock that gives any preference to one shareholder over another. So like preferred, it could be dividend preference or liquidation preference or whatever. We can't do that with an S Corp, but we are able to do this. We can have voting and non-voting shares, and that counts as 1 type of stock. So no preferred and common, that'll be an incorrect answer, but you can have voting and non-voting, and you're good on that. That's not an issue. Okay, so make sure you're aware of that. That's sometimes a trick question that's tossed out there. I don't want you to get tripped up on that, so be prepared for that. Now, the ownership requirements. There are restrictions on who can own stocks in the S corporation. So we know there's a limited number of shareholders that can own it, but there's also certain types of individuals that can and cannot own an S corporation share. So to do this, you have to be either a U.S. citizen. If you want to be a shareholder, you're a U.S. citizen or a U.S. resident. Now, the U.S. resident one can cause some issues because if you're a U.S. resident and then you go back overseas, there's some issues that can arise from there. Then you may not count as a citizen, as a permissible shareholder. Okay, so U.S. citizen or U.S. resident. Certain trusts, they're allowed to own shares in the S corporation. Certain estates can do that as well, and a disregarded LLC. So what is a disregarded LLC? So if you have a typical LLC, it's going to be kind of like a partnership. You're going to have more than one member in an LLC. Remember, owners of a LLC are called members. So if you have more than one, then you're just a traditional LLC. The default is you're going to be taxed like a corporation, but you can make an S election by checking the box. I'm sorry, you can make an election by checking the box, and then you could elect to be taxed as a different type of entity, such as a C corporation. If you're only one shareholder, or one member, I should say, if there's only one owner, then we call that a disregarded LLC. And there's nothing wrong with being a disregarded LLC. You can be a disregarded LLC. That's okay, but it's just considered a disregarded LLC. And a disregarded LLC can own shares in an S corporation. I mean, they're a single individual, really. I mean, they're not an individual, but they're single, right? One owner. But if you're a traditional LLC where there's more than one owner, then you cannot own shares in the S corporation. All right, here's some other things that cannot. Okay, non-resident aliens, partnerships, and corporations. You may not own shares in an S corporation. If they do, if a corporation acquires shares in an S corporation, then what's going to happen is the S corporation is going to lose its election. It's going to terminate, right? Because you'll have an impermissive owner, and it will involuntarily terminate your S corporation. So they could acquire it, but it's going to ruin the S election. So just be aware of that. Okay. Now, the next rule, and what I'm going to do on this one is I'm going to read through the rules on here, and then we're going to work through a few problems, and then we'll go from there. So, first one is the election. All right, when we're talking about the election, you need everybody who's owned any shares in the current year has to agree. 100% everyone, every single person has to agree. Now, what I'm saying is if they've owned shares at all during the year, not if they own shares at the time of the election. So maybe you try making your election on March 4th, but you had a shareholder or an owner who held shares until February 8th, and then they sold their shares. So when you made the election, about a month later, they don't own shares anymore. Doesn't matter. Your owner who sold their shares in February still has to consent. Without their agreement, you cannot become an S Corp in the current year. You have to wait until January of next year. And it makes sense because what's happening is when you make the S election, you're changing the way that you're being taxed. And if you had somebody who was an owner, they shouldn't automatically be told, hey, even though you sold your shares, but now you're going to be taxed like this, you're not going to be taxed like a C corporation or whatever. It may not be advantageous to that previous shareholder. So they have a right to decide. And now at the end of the year, guess what? In the next year, it makes no difference. It doesn't impact them. They're not being taxed on it. Okay, so it doesn't impact them at that point. So 100%, everybody has to agree. 100% unanimous consent on that. Second thing, the election time. So what's going to happen is if you make the election before March 15th, then it can be retroactive back to January 1st. So if you make the S election on March 12th, you have 100% of the shareholders that agree to it, great. You can be an S corporation for the entire year. So March 15th is a key date that you should know. March 15th. So it's actually the 15th day of the third month. But S corporations are generally going to be a calendar year entity. So that's why I keep saying March 15th. But technically it is the 15th day of the third month, which would be March 15th if they're a calendar year. All right. So if the election is by March 15th, then we can go back. Okay. And I have before March 15th, I should have said on or before March 15th. Okay. Because if it is on March 15th, it works. Then what we have is our S election. If it is made after March 15th, okay, if it is made after March 15th, then what's going to happen is you're going to go ahead, and if you don't specify a date, right? If you don't specify a date, then you're going to go all the way until January 1st of the next year. So let's say this is 2026, and let's say that you're watching this and it is April 3rd, 2026, and you make the S election. Well, guess what? You will go all the way until January 1st of 2027 before that S election is good, okay? Before you become an S election. So that's the way that our rule works. So before March 15th or before, go to January 1st. Otherwise, you're going all the way until the first of the next year. So you've got to be able to get those dates down as to when it's going to be effective. Okay, March 15th or the 15th day of the third month is what our rule is. All right, hey, why don't we go ahead and look at some problems on this now? Make sure you have these problems down so that way we're all good on this. We can put that aside and then we can start looking at termination and then what happens with a short tax year. We're going to be focused on the per day method. So we'll take a look at that and make sure you have those rules down. And then we will end the video there. And then I'll do another video dealing with basis and some of those other types of situations. All right, well, let's go ahead and let's work on some of these problems. So here are the 6 questions that we're going to be working on. So our first question is going to be Seminole Research Corporation, a calendar year corporation formed in the year 2024 on February 28th, year 2026. The corporation filed a valid S election with full shareholder consent. All S eligibility requirements are met during 2026. When does its S status begin? All right, remember our rule. It's March 15th, right? So our rule is March 15th here. So what we need to look at is if we want to be within the current year, it has to be filed within March 15th. So we were February 28th, year 2026. All right. So if we did this by March 15th, then we can go then we go retroactively back. So we're going to be January 1st, year 2026. Okay, that's going to be when we are going to be formed. So especially since all eligibility requirements were met, right? That's a big deal. I mean, you have to meet the requirements to become an S corporation in the first place. Okay, let's look at the second one. Buckeye Learning Solutions, a calendar year corporation, started in year 2023. Okay, a valid S election was filed on March 15th. So a valid one, that means everybody's consented. We've met the requirements. 2026 with unanimous shareholder approval. Great. What is the effective date of the S election? Remember, March 15th. So on or before. So we're going to be January 1st, 2026 is going to be our valid S election date. Now let's look at number 3. Bruin Business Corp, a calendar year corporation, filed a valid S election on August 2nd, year 2026. All right, remember, we're looking at March 15th. This is after March 15th. So we will not be effective until January 1st, 2027. Okay, so we've got to wait all the way. So once it happens after March 15th, we go all the way to January 1st of the next year. So the answer for that one will be January 1st, 2027. Number 4, Trojan Consulting Group is a calendar year corporation with 4 shareholders. On February 25th, 2027, 3 of our 4 shareholders signed a Form 2553. One shareholder holding 30% of the stock refused to give consent. All other eligible requirements were satisfied. Is this valid or not? All right. This one's different, right? Because now we're looking at the requirements to actually form the S Corp. And we need unanimous consent. We don't have unanimous consent. We only have 3 of the 4 shareholders that signed it. So this does not become a S corporation. Okay. And you know what? It's not even waiting until the next year on this one, because if we still have the same shareholders and next year one of them still refusing to consent, we can't be an S election. We're going to have all of them agree. Now, if the one who's refusing consent had already sold their shares and refuses consent, or they sell them now and they refuse consent, then we wait until January 1st of 2028 and then we can do it, right? Then we can file the S election and that would be fine, because we just have to have all the shareholders who own stocks within that given year. But in this situation, we're sitting there saying they're still shareholders. All 4 of them are still shareholders. One of them's refusing. So that we can't get a valid S election. As long as there's a holdout, there's no valid S election. Okay, let's go to number 5. A corporation wants to create non-voting stocks for children as part of the gifting plan. Is this allowed? Hey, this is common. This is allowed and is common. Okay, this is very common. When you're looking at trying to gift things over to your children, right? Because of the annual exclusion. So you see some of these things that occur. Well, here's what can happen. You can have voting and non-voting shares, and that's not an issue. You're going to be able to do this. Okay. So you've got a valid S election here. So yes, that is valid. And then number 6, a corporation issues only common stock, but one shareholder signs a binding agreement giving them priority distributions. Does this violate the rule? Yeah, yeah. There's a binding agreement and it's giving them priority distributions. Okay, so they're going to treat that as two classes of stocks because you have somebody who gets priority. And once there's priority, that's not going to, we classify it as two classes of stock. And now it's not going to be a valid S election. It's going to make sure we can't be an S corporation. All right, you guys, I hope that these quick practice problems helped you. Make sure you're on the same page. So what's going to happen now is we're going to go over and we're going to start looking at how do we terminate this S election. Since we know the requirements in order to form it, how do we now terminate the S election? So let's go ahead and take a look at that. Okay, so we've now talked about what happens when we're going to be forming an S corporation and that we needed to have unanimous agreement in order to form it. But let's talk about what happens when we don't want to be an S corporation any longer, or we just no longer qualify. Okay, so we aren't going to meet the requirements to be an S corporation, or we intentionally terminate. So there's two ways that we can lose our status or no longer be an S corporation after we formed it. The first one is going to be voluntarily, or the second one is going to be involuntarily. So when we're looking at voluntarily, what it means is that we have more than 50% of the shareholders. So we have a majority of the shareholders who no longer want to be an S corporation. They want to be something other than an S corporation. So they're terminating their S election. And hey, that's fine. They can do that. But the requirements are going to be different than it is when you form the S corporation. So when we want to terminate, we only need more than 50% who do not want to be an S corporation any longer. Okay, so we just need a majority and they can terminate. We don't need the unanimous consent, which we needed in order to form this election. We only need a majority that says no. So if we had 5 shareholders, they all own 20%, and 3 of the shareholders say, hey, I want to be taxed as an S Corp. I don't want to be an S corporation anymore. I want to be taxed as a C Corp. Well, they can do that. They can absolutely do that if that's what they want to do. Okay, because they own 60% among those 3. If they all own 20%, they own 60%. So they have more than 50%. Even if you have the other 40% owners that want to keep that S election, well, tough luck for them. They can go pound sand because that termination is going to be effective because we have over 50%. So when we're dealing with this S election, right, and termination of it, now we have to figure out, we know that we can terminate it voluntarily, it's more than 50%. So the next question that we have is we have to go ahead and we have to look at when does it become effective? When is this going to become effective for us? Well, here's our rules. If the termination is made by the 15th day of the 3rd month, so March 15th for a calendar year corporation, if it is made by the 15th day of the 3rd month, then and no specific date is specified, then we go retroactively back to January 1st. So if on March 12th of 2026 the termination was made, then and there was no date specified as to a future date, then it's going to be terminated on January 1st, 2026, because we go back to the beginning of the year. Okay, so they can do it on March 15th and make that termination. It'll go back to January 1st if no date is specified. Now, they can specify a future date. So I told you if on March 12th they didn't have a specified date, then it goes back to January 1st. But here's the thing. They could say on March 12th, hey, we want to terminate on, say, September 30th. Okay, you can do that. It could be a future date, and you can specify a future date, and you can terminate on that future date. So it doesn't have to be January 1st of 2027. It could be a date in the future other than the beginning of the next year. So September 30th, August 2nd, um, October 31st, any of those dates are going to work. They can pick that. Okay. Um, Now they could not, if they made this election on March 12th, they could not say, hey, we want to terminate on February 1st. No, no. If you're going backwards, it's all the way back to the end of the year. Otherwise, it has to be a future date of termination. Um, Now, if you made the election, say on March 16th, right? And you don't specify a date in the future, what's going to happen is because it's after the 15th day of the third month, then that termination will not be effective until January 1st, 2027. So now you got to get all the way through the year, and then you're going to be, that termination will become effective January 1st, 2027. Okay. So that can happen as well. So if it's after the 15th day of the third month, then there's no date specified, then it can be put into it. If on March 16th they wanted to go back to January 1st, 2026 or 2026, they cannot do that. Okay. That has to be March 15th or before, the 15th day of the third month or before. So that's the way that you're going to do a voluntary termination, but there's also an involuntary termination that occurs when you no longer meet the requirements. So, for example, you may have a C corporation that acquires shares in the S corporation, and we know that can't happen. If they do that, you're going to lose your S election, and it'll be on the date that the C corporation purchased or owned the shares in the S corporation. So, on the date of the disqualifying event is when the termination is effective. Okay. And if you lose your S status, you generally can't get a new S election for 5 years. It usually takes 5 years so you can do this again. So it's a pretty long waiting period. So you gotta be very careful on how you structure these things because it's easy to get somebody who's not allowed to own the shares that purchases the shares and terminates your S election. Okay, so let's look at some examples here. Okay, so what we have here is we have Tar Heel Textbooks, a calendar year S corporation located in Chapel Hill near the University of North Carolina, has four shareholders. On March 15th, okay, is March 15th, so by the 15th day of the third month, that's okay. The shareholders discussed terminating the corporation's S election. Tar Heel Textbooks meets all eligibility requirements throughout 2027 unless otherwise stated in the specified questions. I gave you 5 questions all related to that similar type of fact pattern. So our first question is going to be, on March 15th, 2027, shareholders holding 75% of the stocks sign and file an S election terminating their S status. They do not specify an effective date. When does the S corporation termination become effective? Okay, so what we're dealing with here is we are dealing with that March 15th. They made the election within the 15th day of the third month, so that's okay. And they do not specify an effective date. If you do not specify it, and it's March 15th or before, the 15th day of the third month or before, then what we're going to do is we're going to go back on March 15th, 2027. So that means that it's going to be valid on January 1st, 2027. That same year is going to be valid, right? All right, so let's look at the second one. Shareholders holding 75% of the stock file a termination on March 15th, 2027, but they specify August 1st, 2027 as the effective date. When does the S election terminate? All right, you can pick a date in the future. That was fine. We could do that, right? Now, they couldn't say February 4th because that's not in the future. So, what we would terminate on this one, August 1st, 2027, a date in the future, fine, great. Example number 3, or question number 3, on June 2nd, 2027, so after the 15th day of the third month, the shareholders holding 60% file an election to terminate the S status. No termination date is specified. When does the S election happen? Okay, it's after the 15th day of the third month. So it's June 2nd, 2027. Let's go ahead and we cannot do anything. Let's see. There's no termination date specified. So we're going to be January 1st, 2028. Okay, we had to go through the entire year because there is no other date specified. So we're going to be 2028, January 1st, 2028. All right. Number four, on August 10th, 2027, Tar Heel Textbook, still near UNC, admits a new shareholder, Raphael, who's a non-resident alien. Does this cause termination? And if so, when? Um, yeah, because now we have an impermissible shareholder under today's rules. So what would happen is that would terminate our S election on October 10th, 2027. Under today's rules, that would terminate it. Okay. On September 5th, 2027, Tar Heel Textbook issues small ownership interest to more than 60 UNC graduate students, pushing that total to over 100 shareholders. Does the S election terminate and when? Yeah, they have over 100, so I'm assuming that the family rule is not applying here. So it's going to terminate on September 5th, 2027. So that's going to be the termination date on it. All right, y'all. I hope these problems are helping you. We still have a little bit more to cover. What I want to do is I want to talk about now when there is a termination, such as this, right? Such as September 5th, 2027. Well, we know it terminated on September 25th. It was an S Corp from January until then. So what we have to do is we have to figure out, okay, how much is going to be of the year is going to be from the first January to September, right? That's going to be an S year. So we've got to be able to calculate the taxes for the S year. And then after that, it's going to be taxes of C corporation. So we've got to allocate it to the C corporation's years as well. So we're going to have a short tax year between our S Corp and our C Corp. What we have to do is we have to go through and figure out how much goes to each section. So what we're going to deal with now is we're going to look at the short tax year and we're going to use the per day method and we're going to be able to figure this out and make sure you're ready for the CPA exam, enrolled agents exam, or your in-class exam. So let's go ahead and take a look at that now. Okay, so before we get into the short tax year, I just want to remind you to go ahead and subscribe to this channel if these videos have been helping you. That way you stay up to date on any new content that I'm posting as it relates to preparation for the CPA, EA, or your exams, and as well as to be able to access the daily tax quiz questions that I post every single day. So that way you can keep updated in the world of tax and always test your tax knowledge. So let's go ahead and talk about the short tax year here. All right, so when we're dealing with a short tax year, what we're trying to do is we're trying to allocate our income across our time of the year that we were an S corporation and the time that we're, say, a C corporation. So we need to figure out how we're allocating this. And the method that we're going to use in order to do this is going to be the daily method. Now, there is an election that you can make, which would allow you to go ahead and to basically close the books to be able to use that as your mechanism for allocation of profits to the short tax year. I'm not covering that in this video. If there's enough demand for it, then I will go ahead and create a separate recording for it. I'm not doing it in this video because this video is already pretty long, so I don't want to continue to add to it. All right, so what we have to do is we have to figure out what portion of the year is going to be the short tax year. So I have an example here so we can see how that's going to happen. Now, what we're basically doing in this example is we're going to say, okay, assume we have a 365-day tax year or a 365-day year, right? We're going to be using that. We're going to count how many days that we were used as an S corporation, and then we'll do the same calculation for those that would be a C corporation. But let's look at this example. So we have Beaver Tech Inc., a calendar year S corporation located near Oregon State campus. It has a S status, terminates on July 20th, 2027, when Pioneer Corp, a C corporation, acquired the shares. All right, so we know on July 20th that a C corporation bought shares into Beaver Tech, which is our S corp, and that was a involuntary termination, automatically terminated it, and the termination existed on July 20th. So basically what we have to do is we have to say we were an S corporation from January 1st all the way until July 19th. Okay, because on the 20th, that's when it terminated. That's now a C Corp. So what we need to do is figure out this year's profit, how much of it is going to go ahead and be allocated to our S Corp years for that January 1st to the July 19th date. So we have for 2027, 365-day year, BeaverTech had non-separately computed income of $438,900. BeaverTech did not file the election under Section 1362E. What amount of the 2027 income is allocated to the S short year? Okay, so how many days, because this is a daily method, how many days were we going to be considered a um, S corporation? Well, you just start counting the days. You say, okay, January 31st, right? Or January has 31 days. Then you go to February 20, and you keep going through each of the months until you get there, and then you go count up to July 19th. Okay, so you're just counting the days. So if you were to do that, you would get 200 days to solve this, to be able to figure out how many days you were an S corporation. So we were an S corporation for 200 days out of the 365. So if we take what our non-separately stated income was of 438.9, and then we're going to multiply that by 200 divided by 365, right? So we can find out what percentage we were, or what we were for the S corporation. We're going to multiply that 438.9 by the 200 divided by 365. That's going to tell us we have $240,493. So for this, for the S year, we're going to have 240,493. That means that all those rules flow through, all those rules apply to that 240,493. The other 165 days, we'd have just done the 438.9 divided by 165 divided by 365, and that would have told us what the remainder of the year was for the C Corp or whatever else, whatever entity we're going to have there. But that's the mechanism that we're going to be using when we go through here. So when you have a question on the CPA exam or the enrolled agent exam or in class, this is what you will be doing if it tells you you're using the daily method on it. All right. Thank you for watching this video on S corporations. This was part one of a two-part series. I'll go ahead and also post the second part that deals with basis for our S corporation.